At its core, volatility simply refers to the relative movement of something, or its deviations and fluctuations from its current level. In the world of stocks, this equates to how wild or tame a stock's price movement happens to be over some period of time. So from that, it's easy to see that implied volatility refers to some expectation around how a given stock might bounce around in the future. Option pricing is controlled by mathematical models, the most famous of which is the Black-Scholes option pricing model. In order to compute an option's price, 6 inputs are required: the stock price, the strike price, the time to expiration, the interest rate, the dividends, if there are any, and lastly, the implied volatility. The only unobservable variable on this list is the implied volatility, while the other 5 inputs are known at any point in time. Again, this is to be expected because implied volatility is by definition some estimate or forecast of the future. Interestingly, even though it appears that an option pricing model would be used to solve for an option's price, the more common way these models are used by traders is to take the option's price as another known input and solve for this unknown implied volatility. If we assume that markets are efficient and prices represent fair and true values, then using an option pricing model to actually solve for implied volatility is completely valid. Still, regardless of whether you use the model to solve for an option's price or its implied volatility, these two variables will always share a positive relationship. In other words, higher option prices lead to higher IV, and lower option prices lead to lower IV. If you think back to what an option contract represents, this makes total sense. An options contract is an agreement between the buyer of the contract and the seller of the contract. Even more specifically, the buyer buys the contract from the seller. Therefore, it's easy to see that an option contract on a higher IV stock is going to sell for a higher price. The buyer of the contract could potentially make larger profits from higher IV, and the seller of the contract could potentially suffer larger losses from higher IV. As a result, the seller is going to charge a higher price to the buyer for a contract on a higher IV stock. As traders, we see IV as opportunity. You see, IV itself is dynamic. It rises or expands, and it falls or contracts. As we'll talk about in a future lesson, we believe that IV has a tendency to revert back to its mean. Therefore, if IV is on the lower end, we might want to take a position that benefits from an IV expansion. If IV is on the higher end, however, we might want to take a position that benefits from IV contraction. Remembering the relationship between the buyer and the seller of the option contract and volatility's relationship with option prices leads us to one of our core principles. When IV is lower, we prefer to buy premium, hoping an IV expansion will lead to higher option prices. When IV is higher, we prefer to sell premium, hoping an IV contraction will lead to lower option prices. Check out the written content below for more information, or proceed to the next video where you'll learn about the expected move of a stock's price and how implied volatility plays a role in that calculation.